Hello, dividend growth stock investors. It is Colby, the DGI Crab, and we're coming at you today once again with the four tiers video where I'm going over each of those 60 dividend growth stocks that this channel focuses on, separated off into those four tiers by age. That is right. I think that age is the most important metric that any dividend growth stock investor should take into consideration. How quickly do you actually need that money right now? How many years are you going to be in the market utilizing those dividends, either by reinvesting them when you're in your accumulation stage or living off of them when you have hit that point where you can retire off of those dividends? Well, sometimes the great dividend stocks are not necessarily worth just waiting around for, hoping that they are going to get cheap. I am always of the opinion that I want to get individual stocks when they are on sale. That's what I try to identify here each and every week when I do these videos. But every once in a while, you've got to sacrifice a little bit of value if you want to add quality, and I'm going to be going over that as the theme of the week here on October 26th. Now, I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment. The opinions expressed regarding investments are my own. You should always do your own due diligence before investing your hard-earned money. This is my personal strategy, and I think that it works pretty great for myself anyway, and hopefully this gives you some ideas for how you can go about acquiring the dividends in your dividend growth stock portfolio. I always put 50% of my new money each week into age-appropriate ETFs, so I have automatic diversification in my portfolio. For individual single stocks, I want stocks that are yielding at least 30% above their 4-year average yield, because that is a sign of undervaluation to me, and I want to acquire that dividend income when I get more bang for my buck. I do have a personal top 10 favorite stock list, my 10 favorite out of this group of 60 favorites. And with those, I don't always wait until I get that 30% value because, well, these particular stocks don't hit that 30% mark all that often, and I want to have a large position in each of these 10 by the time I am financially free. I remain in my tier unless there's a stock yielding 50% or more above the 4-year average yield at a different age tier. At that point, I think there's enough potential for price appreciation on a recovery story for any tier to feel comfortable jumping in and buying it regardless of the yield. If there's not a viable stock in my tier, I just add more to the ETFs for that week. I don't invest less. All right, bargains. Where are they at? Well, let's start with my personal top 10 favorite stocks. These stocks, to me, are great stocks to buy, almost regardless of what age you are. Now, obviously, if you're an older investor and you need yield sooner rather than later, lower yielding stuff like Microsoft and Visa is not going to be super appealing to you. But for the most part, these are great stocks to buy just about whenever. I will have all of these stocks sorted by the valuation tab, where I am taking that 4-year average yield and dividing it by the current day yield, essentially to get the valuation metric. So the valuation metric is how far off the current day yield is from the 4-year average. Pepsi yielding 26.84% higher than they typically have over the last 4 years. This is a slam dunk purchase for me. I was adding Pepsi down in the $130 range. I'm still adding it in the low 150s. Very, very comfortable buying Pepsi. Not getting that starting yield at 4% right now, but 3.75 is still perfectly good for me. So now let's break it down by age. Tier 1, the age 18 to 30-year-old investors. Really 30 and younger really ought to be kind of ignoring the starting yield number, not chasing yield, instead going for dividend growth. This group of stocks, we want to get on average between them about 11% a year dividend growth rate. Maybe even better in some years with some of these stocks. Now, they're not all going to grow that much, so that's why it's nice to have a collection of stocks. I think that breaking these down into these age tiers is going to make this a lot more manageable for a lot of investors. You could just kind of focus on a smaller group of stocks, buy the ones that are undervalued when they're undervalued, and just hold and reinvest dividends. I think that's the simplest way to go about acquiring passive income. Buy quality and buy stuff that you can set it and forget it as far as the dividends are concerned. United Health and Nike, look guys, these have been down in the dumps for a little while now. Nike in particular, Still well above their 4-year average yield. I update the 4-year average yield every single week, you guys. So these are totally up to date numbers every time you watch one of these new videos. Obviously, Nike's been down for like a year. So because of that, their 4-year average yield has just continued to climb and climb and climb. It is still looking to be a value, even though it's been down in the high 60s, low 70s for a while now. I've been accumulating a little bit of Nike every single week for over a year now. I've got a pretty nice position in Nike. And at some point in time, I don't know what's going to cause it to happen, but at some point in time, I'm quite sure that Nike will eventually have a huge recovery story, and they're going to become $100 per share stock once again. I have no idea when that's going to happen, but I'm thinking long term here. I'm not thinking about next week, next month, even next year for that matter. I'm thinking years into the future on this one, and very happy as a 30 and younger investor, especially. I've got a couple of great options here yielding well above 2%, which is a lot higher than what we would typically expect out of this group. As far as a stock that I won't wait around on necessarily, I'm still adding a little bit to my waste management position. One of my top 10 favorites. It is yielding just a little bit higher than the 4-year average yield. I'm not waiting on this one to get cheap. Waste management hasn't been this low on the share price for quite a while now. And I'm okay to go ahead and jump in and buy this one a little bit early. Age 31 to 41-year-old investors, starting yield in this group is going to be a little bit higher in the 2 to 3% range. Year-to-year dividend growth rate, we're going to be shooting for high single-digit dividend growth rate, 7-8%. Target, McCormick, Hershey, and American States Water are in that buy zone right now. Hershey had finally gotten out of that buy zone. It had gotten up in the high 180s, and it slid back down just a little bit. So I'm going to be graduating you guys next week into tier, or not this current investing week, the week after. I'm going to officially be in the tier 3 category. So Hershey won't be as big of a priority for me personally anymore. I'm so happy that I've gotten the opportunity to build this up. This is one of my 5 largest individual single stock positions because of how far down Hershey's been and for how long. Still adding away, still more than happy to keep adding it. I think Hershey should be priced, pretty comfortably above $200 a share, and it probably will be in the future. American States Water and McCormick. So I was saying last week, you guys, 2 of my very favorite dividend growth stocks. These guys are not exciting. They are just super duper steady. The absolute definition of a tier 2 stock, where when you're getting it, hopefully you're getting the yield and above 2.5% when you're buying it, and you're going to pretty steadily get the 7 to 9% a year dividend growth out of both of these. They are ridiculously stable. And Target is trying to recover a little bit. When it was yielding up above 5%, it was just getting absurd. Still underpriced, and still happy to add Target, getting near a 5% starting yield. In this category, I'm also really enjoying adding Union Pacific right now. I'm trickling a little bit more money into the largest railroad in the country. And McDonald's recent dividend increase just made their current price a little bit more attractive. Probably not going to add to McDonald's just yet, but Union Pacific and McDonald's are underpriced enough that I wouldn't be turning my nose up at you if you were adding to them at these prices. Tier 3, age 42 to 53-year-old investors, where I am going to be here very shortly as we get into the month of November. This group of stocks, we're looking more in the 3 to 4% starting dividend yield and a little bit slower growth rate. Usually out of this group, you're looking to get somewhere in the 4 to 6% range on the growth. But these are just really stable, help get you across the finish line kind of stocks, in my opinion, because fortunately for me in my position, while I'm certainly not a millionaire at this point in time, I am doing my best to get there and have a nice group of holdings in the tiers 1 and 2. So it should have good dividend growth rate for the rest of my life, no matter what happens at this point in time. So now instead of chasing yield, someone in my position can just start adding a little bit higher starting yield, just to try to get there a little bit faster. If you're just starting out in your 40s, and this is the group of stocks that you're building your portfolio with from scratch, you're going to get a good solid starting yield, high 3s, low 4%. So you're going to start seeing income coming in pretty quickly. And all this stuff should continue to grow much better than the tier 4 category, which we're going to get to in a moment. Hormel, way down, I'm still adding. I'm just going to take the high yield right now and hope that they can continue to gradually grow their dividend over time. They're dividend king. They've grown their dividend for more than 50 consecutive years. I think they're going to get through this with the dividend safe, but that'll be a decision management will have to make. I'm monitoring it right now. I'm not concerned. And Procter and Gamble right now, again, one of my top 10 favorites, doesn't typically get super cheap, so I'm going to be pretty happy to add this one. 13% discount, 2.77% starting yield, 4-year average 2.44%. Procter and Gamble is going to give me a great combination of share price appreciation, starting yield, dividend growth. The thing is pretty much bulletproof as far as a dividend growth stock is concerned. Tier 4, age 54 and older investors. This has not been a cheap category here for the better part of a year, more than a year now. Smallest group in the channel, only 10 of the 60 stocks fell into this category where we get good high starting yield. Hopefully, as a group, we're getting dividend yield above 5% in this category with a growth rate that's not thrown out the window, but hopefully we're still getting 2 to 4% dividend growth out of this group of stocks. But not amazing values here, but I'm really starting to change my tune a little bit when it comes to One Oak. So One Oak, it's been around for a little while. Big company, big energy producer. They acquired, and I don't remember the date offhand. It's been within the last year or two. MMP, which was an excellent income stock. It was an MLP, meaning that if you were receiving dividends from MMP as a stock, you had to deal with the K1 tax form, something that I don't personally like to deal with. Which is why MMP would not have made this particular list if it was still around. But it was one of those stocks that typically would have a 7-8% starting yield, and they grew that dividend year over year by about 2%. Kind of like Verizon. It was like the Verizon of MLPs in terms of its performance. You usually wanted to buy it in the 8% starting yield. You'd get about a 2% yield growth every year. Decent enough combo factor. Well, they were acquired by One Oak. Now, One Oak is not classified necessarily as an MLP, so their dividends are qualified, meaning no K1 tax form. And when when the two companies combined, One Oak share price shot up above $100 a share at times. I mean, it was just flying high, and now it's kind of come back down to earth. It's looking more fair valued here in the high 60s, and maybe that starting yield at 6% is a bit more appealing than I'm giving it credit for based on the 4-year average, because the 4-year average in this case does not encompass all of that additional income and all of that from MMP. So that's only just a part of the 4-year history. So if you're buying One Oak right now, let me know. If I was about 10 years older and I was sitting here and going into nearing tier 4 range, tier 4 age range, I'd be looking at a starting yield of 6% or better and thinking that it looks pretty appealing. Let me know what you think. All right, and then as far as the strategy for the week, so this is kind of how I'd break it down here, you guys. Half the money into the ETFs. If I was 30 years or old or younger, I'd be putting a quarter of that income into the S&P 500, 15% into a small cap value ETF, and 5% into VIG to get dividend growth, 5% into BYMI for international exposure. Tier 2, where I am now, same 4 different allocations. And then Tier 3, I'm going to be jumping into SCHD, VYM, DHS. I do not own any of these 3 ETFs in my primary brokerage. All I have of any of these is just what I have in the great ETF race in the separate series on the channel. So I'll be interested to see how adding these 3 ETFs is going to impact my immediate dividend income as I'm still getting to financial freedom. And then my breakdown here, as far as the different tiers goes, there is a lot of different ways that you can split this up, you guys. But like I said, my primary focus is going to be 30% or more above the 4-year starting yield, and anything that's in a tier or anything that's yielding 50% or more above the 4-year starting yield, I'd grab it almost regardless of tier. So stuff like Target, Nike, Hormel, yeah, they're beaten up, but I'm still going to add them. And then the super quality stuff like Waste Management and Procter & Gamble, I'll just jump right in there and add a little bit now. What are you guys doing? Let me know in those comments.